Don't play red light, green light. Why do you want to take so many steps forward and then so many steps backward toward your retirement? How can you make money in up and down markets? In this episode, you'll learn how. Welcome back. My name's Doug Andrew, and I'm passionate about providing you with insights into opportunities that maybe you didn't know existed before. And as an author, speaker, radio show host, and helping people optimize their financial assets for more than 45 years, I've used a lot of metaphors, a lot of stories. I've written articles, and this episode talks about an article I wrote that I titled Red Light, Green Light. Now, when you were a kid, did you ever play that game, Red Light, Green Light? Or maybe Simon Says? You all get lined up, and of course you're turning around, and you know, red light, green light. And green light, you hurry and try to make some steps. And then turn, red light, and if they turn around and they catch you moving like it's a green light, then you have to go back. And so red light, green light. So you're moving ahead and then you're going back, up and back, up and back. That's like most people's money in the market. Now, I had a Series 1 securities license clear back in 1974. They don't even offer that anymore. That was sort of the granddaddy of all the licenses. I could sell any stock, bond, mutual fund, and so forth. And I was doing my darndest. In fact, by 1974 to 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And so their money was in the market, and I had them diversified into mutual funds. And we were trying to average maybe 12% back then. And we were doing a pretty good job. Now, a lot of times you'll hear advisors say, oh, hang in there, you'll average 12%. Well, actually, that's not happening, and I'll explain why. When you have your money in the market, emotion gets in the way and people buy and sell at the wrong times. And so what happens is you're going up and back, up and back. People are only netting about 3.5%, according to Dalbar. Dalbar studies investor behavior. The fact of the matter is, they said, in any 20-year period in the stock market, clear back to the Great Depression, if you diversified, let's say in the S&P 500, the top 500 companies, if you bought and held and left your money alone for 20 years, you'd probably average 9.14% before tax. When you pay tax on that, either as you earn it or if it's in a tax-deferred IRA or 401k, you have to pay tax when you take it out. So you're not really earning 9, you're netting about 6. Because about 1/3 of that goes out to the federal government, and in 41 out of 50 states, the state government. So if you earn 9 on $1 million, let's say, you instead of earning $90,000 that you get to keep, $90,000 you have to pay tax of $30,000 to net 60. And sometimes that's not cutting it, but people aren't earning 9%. The investor return is only 3.49%. Why? Investors, they have their money in the market, and when it comes down, 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 they get panicked and they sell low, and then they wait until it goes up, 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 and then they finally buy in. They're buying and selling at the wrong time, and they miss the biggest gains. And so emotion comes into play, and they only average about 3.5%, and that's pretty pathetic. So in actuality, they're only taking about 3.5 steps net forward. Well, let's go back to the 12%. I was actually doing a pretty good job helping my clients earn an average of 12%. But here was the problem. If I was earning 12%, let's go back to red light, green light. In a given period of time, 1 year, whatever, I earned 12%. So I'm taking 12 steps forward, right? Well, even E.F. Hutton, who was the brainchild behind my favorite vehicle, which I call the Laser Fund, which is a max-funded insurance contract where I've actually averaged 10, sometimes 12%, but this is what Hutton thought. Why are we, because they were a brokerage firm, they made money by turning people's money in stocks, in the stock market. And they thought, why are we trying to average 12? I mean, some periods, they were taking 20 positive steps. The next period, they were going back because the market lost, back and forth, like red light, green light. They said, well, golly, that's sort of silly. But if you averaged 12, you weren't really netting 12. So let's say you average 12 steps forward. At the end of the day, when you take the money out of an IRA or 401k, most people had to take 4 steps back. In what? Taxes. And most money managers, they charge a 1% fee. So on that $1 million, that's another 1%, so that's another step back. So if you earn 12, you're having to take 5 steps back in taxes and fees, you're only netting 7. You had to earn 12 to net 7. So $1 million wasn't earning $120,000, it was only earning $70,000 to buy gas and groceries. Hutton said, we can do better than that without all the up and back, red light, green light game. Now, they didn't say red light, green light. That's one of my metaphors. But that's what they meant. Why don't we just put our money into a safer environment in the multi-trillion-dollar insurance industry and do the opposite? Instead of trying to get the most amount of life insurance for the least premium, they said, let's flip it. Let's get the least amount of insurance the IRS will let us get away with and put in the most money, and this thing will turn into a cash cow, and you'll use it for tax-free accumulation, tax-free income, and tax-free transfer, which will knock the socks off of earning 12% in the market. The insurance companies on my laser funds that I had back then were earning between 11 3/4 to 15%. Let's just say 11. So I was taking 11 steps forward and only 1 step back. What was that step back? It wasn't taxes, it was tax-free. That was the cost of the insurance that the IRS said had to be there, or it wouldn't be tax-free. But see, I only had to take 11 steps forward, which was safer, more predictable than trying to earn 12% or even 15% of the market. I'd have to earn 15% in a mutual fund to net 10 or 9 after taxes and fees. I only had to earn 11 to net 10 in a conservative insurance contract. 10% tax-free, not bad. In fact, from 1980 to 1990, I never earned less than 11 3/4%. I'm still earning about 11.17% average, earning 11, netting 10. Some years I don't make that much. Some years I make way more than that, but these are averages. So that's what I mean by red light, green light. I don't want to have to go up and back, up and back. I just want to progress a nice, even, average 10 positive steps, but never have to take steps back. I may have to wait patiently 1 year while everybody else is taking steps back. I don't have to. I just wait till it's time to move forward again. Don't you want to just keep moving forward? That's what you can do with your money. So how does this all play out? Let's go back to the 4% rule used by the financial services industry, where they don't want you to withdraw more than 4% of your money out of a mutual fund portfolio, out of IRAs or 401ks in the market, because they don't want to be sued for you outliving your money, because the average return is only 3.5%. And if you're earning only 3.5% and you're pulling out 4%, you're slowly depleting your nest egg, but probably not before you check out, you pass away. That's called the 4% rule. Let's say you pull out $50,000 a year out of an IRA or 401k. And you're paying 28% in tax between federal and state. So you pay $14,000 of the $50,000 you withdrew every year in taxes. You're only netting $36,000. Now, $36,000 is $3,000 a month. Now, first of all, that may not be enough, but okay, $3,000 a month, $36,000 a year. My question is, what is $50,000? How much did you withdraw? 50 to net 36. What is $50,000 4% of? $1,250,000 nest egg. In other words, you would have to have $1,250,000 in an IRA 401k to pull out 4%. 4% of $1,250,000 is $50,000 a year to net $3,000 a month of income. I mean, if you're anything like me, do you save $1,250,000 to have a measly $3,000 a month to buy gas and groceries? That's pathetic. The reason why I like the laser fund and I want it to be green light, green light, green light, no red lights, no steps back, using indexing, is because I can earn an average return of 10%. I could have $1,250,000, and if I earned 8%, that's $100,000 a year of tax-free income. How much better is $100,000 versus $30,000 $6,000 net after tax. It's like 3 times as much money. But I've actually been earning 10.07. What's 10% of $1,250,000? $125,000. Let's see. Would you rather have hamburger A or hamburger B? Hamburger A only gives you $36,000 a year of net spendable income to buy gas and groceries or prescriptions. But hamburger B over here, it gives you $125,000 tax-free. Which would you rather have? It's like a no-brainer. What we have helped people do for their hard-earned money in retirement isn't a little bit better. Not 10% more, not 20% better. It's 100, 200, 300%. Sometimes it's double, sometimes it's triple. Many times we have quadrupled people's net spendable income by employing these strategies. So please, if this is resonating with you, arousing curiosity, watch this episode and you'll understand how to bring this all together and eliminate the greatest dangers, seize the greatest opportunities, and harness the greatest strengths of liquidity, safety, predictable rates of return. And you'll be given the opportunity to get a free copy of my most recent bestseller, The Laser Fund, over 300 pages of charts, graphs, explanations, and 62 actual client stories. And you just pay $5.95 shipping and handling, and I'll fire one out to you for free. And then you can also watch 18-hour deep dive masterclasses. So I want you to be empowered and not play the silly game of red light, green light with your money. And why take a bunch of steps back and forth going towards retirement? How you can make money whether the market is going up or down.